Welcome to This Week in Money. I'm Jim Goddard. Today, Chartworks CEO Ross Clark talks about a seasonal play in gold and reflects on the markets for the start of the new year. PeakProsperity.com co-founder Chris Martenson comments on whether the Trump tax reforms will be good for the U.S. markets, the threat Mideast conflicts put on the flow of oil, and how the Saudis are now doing multi-billion-dollar deals with Russia and China. Founder of EdSteerGoldandSilver.com, Ed Steer, talks about how the manipulation of gold and silver is keeping prices down, and that's discouraging traders from spending more on that market. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Ray. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Chartworks CEO Ross Clark. Welcome back to This Week in Money, and Happy New Year, Ross.
Pleasure to be with you, and a Happy New Year to you.
Is gold making a seasonal play?
Well, gold is, for what do we got? 5 out of the last 6 years, we've ended up with a mid-November, late December bottom, and just an exceptionally good rally. And this year, up $80 now off the bottom is definitely into that pattern that we've been recognizing. And in a bull market, you'd expect to see this type of strength. In a choppy market like we had leading up through a year and a half ago, it was a pleasant surprise. And now in a flat to rising market, it's truly something you hope to see. But historically, it's only just over half the times that you have this seasonal play. This year was a perfect setup in that we went down and we tested a support level. The commitment of traders numbers just got to the point where on silver, you almost had a net short position by the speculators. Gold was down to one of its lowest speculative long positions that we'd seen in the better part of a year. So to get a bit of a reversal there off a bottom and then get weakness in the U.S. dollar, it really became just a great catalyst for this move that we've seen so far. And the pattern is, as I like to call it, it's an isolated low where you've gone down, you've taken out a good support area, and just in one consistent move to the upside. I don't think there was more than a 2-day pause all the way from where we're on the 15th of December to where we've finished off this week. No pause of more than 2 days. And that type of isolated low is really something that we've looked for over the years. That they're really nice to have. And with this action, we're, I believe, about 17 days into the run, 17 trading days. And the norm is that we would be probably double this in terms of days before we get to the top end of at least this run. And, maybe that becomes a seasonal high, but for this run, it's doing what we'd expect to see.
Is there a chart available on what's happening with gold?
Yep. I put one out to subscribers at the end of the week, and if people are interested, they could send me an email directly at ross.clark@chartworks.ca. I'll send them along a sample of what we're putting out right now, and as we get through this move, there's certain characteristics that we'll look for at the top end of the run, and maybe we'll be able to ring a bell. We'll give it a try. But for now, we've got good overbought readings. We look for a pause, a minor one, and then say a continuation to the upside. And we've got parameters that we'll look for around the top of this move.
We're getting used to this. Record highs again set in U.S. equity markets.
Isn't it something? The sell the news on the tax legislation was something that really hasn't come about. Tax legislation allowing now for repatriation of funds from offshore at more attractive tax rates, clearly being a big plus for the big cap names, the Dow, the S&P, not having much of an impact on the Russell 2000, the small caps, and that trade really underperformed this year. It was a small gain relative to what we've seen in the past. But the big run that we're seeing on the large cap names, we're now, 13 consecutive months with higher lows on the S&P. That matches the absolute record. Only once have we seen that since the S&P was formed in 1928. So the norm off of this, we've mentioned this before, is that you might have a 1 or 2 month correction, but then end up back into new highs. And the other thing I've been looking at, the persistence of this rally of the last 2 years, its inability to give back much at all on the gains, stands out similar to maybe half a dozen examples in the Dow that we have going back over the years. So we're up about 63% off those January lows of 2016 right now, just over 50% in terms of the S&P. But when we look at correlations to this, the norm has been that in the third year of the run, the high has been a minimum of 80% above the low to a maximum of 132%. And along the way, there was invariably a small correction at some point in the end of the second, early part of that third year. For now, we've got momentum, but I would say that looking at the supporting levels underneath, and because we're in a bit of an exponential move starting in here, you need to be careful. Any time that we would take out what I would call a 2-week trailing stop loss, so that would be the lowest low of the preceding 2 weeks, that would probably be the catalyst for an initial correction. We're thinking towards either the 20-week or the 50-week moving average, depending upon how overextended the market is. But from that corrective low, once again, look for new highs as we move through the year.
Ross, what was that email again for somebody who might be interested in your gold chart?
That would be Ross, ROSS.Clark, C-L-A-R-K, at chartworks.ca.
Ross, thank you so much for chatting with us.
My pleasure.
My guest has been Ross Clark, CEO of chartworks.ca. Coming up, peakprosperity.com co-founder Chris Martenson, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Chris Martenson. He's the co-founder of peakprosperity.com. He's speaking to us from Massachusetts. Chris, welcome to This Week in Money.
Jim, it's a real pleasure to be here with you and all your listeners.
Chris, could you give us a bit of a story about Peak Prosperity and what you're all about?
Well, sure. The story is that I have a science background. I was in corporate finance for a long time, and I started looking at some data that concerned the economy itself, levels of debt, indebtedness, unfunded entitlement programs. I'm a curious guy. I started to put things together, and this big story popped out, which includes 3 E's, the economy, energy, and the environment. I synthesize all of those into one story, and the website is really dedicated to talking about how there are enormous changes coming, some of them positive, some of them not so positive, but we're here to alert people to these changes so they can be prosperous in any future that happens to arrive.
Now, can you explain how the 3 E's affect the markets?
Well, sure. Our markets, in a word, are based on infinite growth. I guess that's a phrase, right? So our markets are always geared for growth, and really when we talk about markets, what do we mean? We mean stocks and bonds, I guess, and there's real estate markets and tangible markets. But what we're really talking about are things that are claims on what I call real wealth. A fistful of cash does no good unless I can walk into a store and buy something with it. So the 3 E's come together when we look at the size of the world, what's available, where the resources are coming from, and we understand that those resources aren't infinite, but the claims on them are growing really, really rapidly. Quick statistic. Our credit markets, total debt in the system, has grown at a compounded rate of 9% per year since the 1970s, but our economy has only grown at half that rate. Look, Jim, you as an individual know that you can't grow your debts at twice the rate your income forever without having a math problem. And that's the kind of analysis that we're providing at Peak Prosperity. Very high level, very macro, saying, hey, this doesn't add up, and if it doesn't, what are the implications?
We've heard predictions that the Dow is on its way to 40,000 on Wednesday. It topped 25,000 for the first time. What do you see ahead for the Dow?
I see more bubble behavior going on. Remember, the central banks got into emergency money printing. They called it quantitative easing. They started that back in 2008 and 9. They continue with it at what I consider to be emergency levels, a little over $100 billion a month printed out of thin air, pushed into the markets. That's driving a lot of the things that we're seeing. My prediction is really a speculative position, which is that the central banks are going to continue to print. I'm speculating on that. As long as they do that, there's more money that has to go somewhere, and it's going into the markets for now.
Will the passing of the Trump tax plan supercharge the stock markets through the new year?
It's a complex question. I'm not sure it will. The crux of that argument, Jim, is that the companies are going to repatriate all this money sitting offshore. What are they going to do with it? Well, they're going to continue the share buybacks, which have run at really record levels the last 3 years. Can it continue for a fourth? The idea is there's fuel there and offshore money. I'm not convinced that the companies are going to use the tax code change to bring that money back. That would presume that the companies have money over there. It's just a lack of money that's prevented them from buying back more shares, but nothing could be further from the truth. It's easy for companies to raise money in the debt markets. They've been issuing debt like crazy. They've been using that to retire shares. Makes a lot of sense. So I don't see them as being capital constrained right now. Instead, we have to ask the question, what might they use that money for? Will they use that to really foster, incredible growth in the underlying shares because they're investing in new productive property, plant, and equipment? There now, it's a different question, but again, I don't see companies as being capital constrained, so I'm not sure this money is going to come flooding back.
Are the Dow and the S&P 500 good predictors of an approaching recession?
They used to be, but not in the last couple cycles. So they've been a little bit behind the game. They used to be great discounting machines, giving you an early read, but in fact, that's kind of been lost. And I'm going to, again, I put some of the blame for that loss of the signaling function, again, at the feet of the central banks, who took the price of money, distorted it so wildly that it's very difficult now to use what used to be reliable signals, things like flattening yield curves don't provide the signal they used to because, of course, the central banks have been monkeying with the yield or the price of money. So that it's really difficult to say what's a predictor, what's not. We know that the Japanese central bank is buying the Nikkei and other ETFs representing Japanese shares with such abandon that they are now the largest holder of such things. So when you have central banks intervening and interfering with markets as they are, the signals are harder to read. So that's why I think we have to look at trade data, macro data to understand where we really are.
Which sectors are you watching for 2018?
Oil and energy. This is really exciting area. I'm long of the opinion that oil is below the marginal cost of production for new stuff like deep water, ultra deep water, tar sands, things like that. So no commodity as important as oil can stay below its long-term cost of marginal production. Fancy way of saying, hey, if it costs more to get one out of the ground than it's currently worth, you won't get more out of the ground. 2014, 15, 16, and now 17 confirmed is the worst 4-year stretch of oil discoveries in all of history, in the history of oil. So guess what? I think that we're going to see that begin to bite sometime this year, 2018, and there's a lot of derivative stories off of oil. Food is a derivative. If oil goes up, price of food goes up. So I'm really looking for the commodity complex in general to be a pretty exciting place this year.
Out of all the commodities, what do you think is going to be impacted the most if oil prices, say, go up to $100 a barrel?
Well, I'm looking for food to make a big run. I'm looking for metals to make a run under that scenario. Copper's been obviously signaling a pretty important move here at this point in time. So generally speaking, the whole commodity complex is not a bad place to begin to look, but food is a big focus in this environment and metals as well. But I like the energy complex most out of that story.
Are central banks tightening the availability of credit?
Oh, Jim, no. I wish that they were, because then that would be a real change in this story. Everybody knows the Federal Reserve says they're tightening, but what they're really doing is raising interest rates at the risk of being wonkish. What normally happened when they raised interest rates was they didn't have a magic dial. They would have to go and remove money from the marketplace, and then banks would have to scramble for those overnight funds that they needed to square their books up. And if they removed money, interest rates would go up. That's what we meant by tightening. The amount of available money in the system was reduced. That's tightening. Today, ever since 2008, the central bank in the United States has been able to raise interest rates by raising something called interest on excess reserves. It is a dial that they set. They can just twist that dial, and then banks have the choice of either lending money to the Federal Reserve or out in the open market. So the Fed has not had to remove a single dollar from circulation to affect the rate hike from 0.25% to 1%. They haven't done not a single dollar has been removed, so no tightening in the system yet.
Do you really think that they're going to raise rates 4 times this year like they've promised?
I think they will, because it's really a question of optics. They want to show that they're making moves. Again, it's really optics more than substance, because they're not removing money when they do that. What happens as a result of raising the interest rate? Well, we see some squeezing at certain end. Anything that's tied to the short end goes up a little bit, becomes a little bit more expensive. But at the same time, we're not seeing any significant moves on the long end, and that's where things like home mortgages get priced, and auto loans and other things. So we'll see interest rates go up on the short end, but it doesn't really affect all that much. But most critically, it means that there's no tightening because of how they're doing that rate hike mechanism. And because there's no tightening, we're not going to see any real impacts on levels of business lending, availability of money, overall credit, all of that. None of that's changed in the story.
Could debt bubbles be inflated indefinitely?
Well, no, they can't, because eventually, what is debt? Well, debt's a claim on money, actually future money. So there's only so large your debts can really get before they become inhibitory. They really begin to drag and everything. And then once they've dragged too far, we see the implosion of those credit bubbles. And so we saw that with the housing market in 2007-8. I think we're going to see that next in the United States with subprime auto loans, probably the next candidate to watch something like that happen. And all that happens when you extend credit too far is you get bubbles, you get inappropriate investments are made, what are called malinvestments, and then as Warren Buffett famously said, when the tide begins to go out, when the credit no longer can be extended, when the credit wave begins to go the other way, that's when you find out who's been swimming naked. And we've seen a lot of that starting to show up already.
With all the debt bubbles, should gold be a multiple of where it is now?
Well, I think so. Because gold for me is not an inflation hedge. It correlates poorly with inflation. What gold is, it's a representative of money, and it does well during times when financial crises or instabilities come forward. It's very clear that bubbles end in financially unstable ways. We saw that with the practical dissolution of Greece in 2009 and 10. We'll see that, we saw almost the break apart of giant companies that got in trouble, Citibank, Bank of America, things like that. So credit bubbles result in financial crises. If we see one of those come forward, gold should do really well. And I think that gold actually probably is undervalued at this moment in time. And we'll see that's another sector when I said metals before. Gold and silver, more so silver, are metals that I think have a pretty good chance of getting a good run this year.
Are you more bullish on gold or silver this year?
Yeah, silver a little bit more from a percentage standpoint, but they're actually two separate words for me. People say gold and silver as if it's one thing, and we call that precious metals. Gold is your hedge against a monetary disorder or some sort of a currency accident or some sort of financial system instability. Silver is your bet that the industrial economy is going to pick back up, and it's a desired, necessary element out there. I love silver for all the things it does, and it does things that no other element can do, and it's finding increasing usage, and it's actually a little bit, on that basis, I think it's really heavily undervalued.
What is the copper market signaling? The numbers are tremendous compared to this time last year.
Yeah, so Dr. Copper should be telling us that the world economy is about to pick up and get some legs here. That would be a really welcome advance at this particular stage of the story. This has been a really long, frustratingly slow, low-growth recovery. Dr. Copper seems to be saying that things are about to get roaring here, and that's what we can hope it's saying, but it's unclear if that's the case yet, because a lot of copper's price is driven out of China, and there's a bit of investment going on and a lot of speculation going on as well. So sometimes that signal is getting a little hard to understand.
We'll have more with Chris Martenson next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with peakprosperity.com co-founder Chris Martenson. He's speaking to us from Massachusetts. Chris, what do you think is going to happen on the Middle East sector, especially with so many people talking tough there, riots in Iran? Is that really going to affect the price of oil, or are we pretty independent on this side of the water?
Oh, this is an area we absolutely have to keep our eyes firmly fixed on, Jim. You know, oil is an international commodity. 40% still of all the world's oil that is exported comes through the Strait of Hormuz. As you know, Iran's on one side of that, and a bunch of other Gulf states on the other side of that very tiny, narrow channel through which all that shipping traffic passes. So it's really critical to look at that. As well, we saw some of the most interesting, dare I say, exciting geopolitical realignment around Saudi Arabia this year. They visited China in 2017. First time in history, Saudi Arabia visited Moscow. So this big pivot to both Russia and China, with extraordinary trade deals in tens of billions and collectively over $150 billion worth of deals, which is big. And so what we're seeing is Saudi Arabia clearly pivoting away from the U.S. towards China and Russia. That has enormous implications, I think, for the price of oil and also what stability or instabilities may come forward in the region. And that could absolutely impact the price of oil.
Do you see China snapping up all the available shares when Aramco goes public?
Yes, quite probably. There's some really big news here, which is that China in 2016 became the world's largest importer of oil, surpassing the United States, and it continues to ramp up. And little publicized, but very important fact is that China's Beijing Petroleum University came forward with a study they released last year that said China is facing its own imminent peak in oil in 2018. That's this year now. And that their imports are going to continue to climb. So China is very actively using its magic checkbook to lock up whatever supplies it can. It really has to scour the world very carefully for what it can for oil import supplies. China is the main driver of the oil import story for this year, next year, probably the next 5 years.
Are you bullish or bearish on the U.S. dollar?
Well, that's a trickier one to sort of peg here. I think I was expecting the tax overhaul bill to have created more of a bullish environment for the dollar. Got that dead wrong. The dollar's actually been heading down and looking at a technical weakness here at about the 91, 92 level. And I guess the explanation for that is that the increase in the deficit that's coming forward from the tax plan is outweighing at current any repatriation flows that we might have anticipated from that. So for now, it looks like the dollar is pretty weak. I'm expecting that trend to continue for a while. I don't see anything that's going to turn it around, but if we get through this first technical level, I'm looking for a significantly lower dollar over this next year.
Interest rates and the bond market, do you see trouble ahead?
Well, there's places where there's obviously a vast amount of stored potential trouble, and that's in the junk bond markets. I'm absolutely gobsmacked that we see a condition where in Europe, European junk debt is now trading with less than a 2 handle, less than 2%, meaning it's trading at a premium, a vast premium to U.S. 10-year Treasury notes, a very, very odd condition, and one we could easily predict is going to have some losses in it. So my model, Jim, is from the outside in. I always like to look at the weaker things first because that's where trouble starts. I'm keeping a close eye on the junk bond market. Nothing there yet to say it's too bad, but that's a place I'm really would not be at all surprised to see some big trouble start in 2018.
What are your thoughts on Bitcoin and other cryptocurrencies?
We're clearly in strong bubble territory at this point. I know a lot of people who are invested in it who don't have the slightest idea of the difference between a digital currency, a cryptocurrency, and blockchain or any of that. So we're seeing a lot of people speculating, strong speculative flows. It's really exciting technology. Obviously, there's a suite of technologies associated with this. I think there's going to be some great uses in that, but where are we in the story? It's kind of early stage internet. It's not clear who the winners and losers are yet, but it's really important for people to understand. I think the answer is to two questions when you're looking at a digital asset. What problem is this thing solving, and does it do it faster, better, and cheaper than current solutions? If you can answer those two questions, there's some real exciting things in that space, but there's a number of real dogs out there too, but people are buying all of them. So that's what leads me to think we're in more of a bubble right now. It's just early stage technology, very exciting. We're going to have to watch it.
Are cryptocurrencies a way for governments to make debt disappear?
Unlikely. I do think that governments are going to step forward with their own solutions as rapidly as possible. Banks are going to have to do it because cryptocurrencies have the danger of completely disintermediating entire swaths of the financial industry. And so, currencies themselves, yes, we have to watch those, but the distributed ledger system is a big threat to a variety of key financial players right now. So all of these things bear watching, and governments, if they find these too destabilizing, of course, will come forward with their own solutions. I'm not sure if that'll enable governments to wipe out debts. The only thing that really allows them to do that, there's only two ways to get rid of debt. One is you default on it. The second is you inflate it away. Digital currencies are not a great way of inflating things because they have just in their very construct, it's impossible to overinflate them unless you design them that way, but then nobody would trust them.
China's cracking down on cryptocurrencies because they say just too much energy is being consumed by Bitcoin miners. Is that a legitimate excuse on their part?
Possibly for Bitcoin itself, if you understand how Bitcoin is constructed. Jim, if you or I exchanged a Bitcoin, it requires an enormous amount of computational power from these entities called miners to validate that transaction. First to crack it and then to have other pieces come forward and validate it. So that just in its construction, it requires an enormous amount of energy. But guess what? There are other digital currency, cryptocurrency solutions coming along that don't require that same approach. So if China cracks down on the general field of cryptocurrencies because of the way Bitcoin is constructed, then they're using it as an excuse, but it's not an illegitimate concern. The Bitcoin transaction requires an extraordinary amount of power, electrical power, to execute.
Do junior stock markets run near the end of a bull market cycle?
Well, we'll see a lot of things begin to run towards the end of the cycle. That would be one. We'll also see real concentration of leadership, and we're seeing that as well. So, listen, this is the largest of stock bubbles. I'm calling this the everything bubble. This is the largest we've ever seen. When I first started in this business, Jim, we would see central banks maybe put in $5 billion of new currency on a weekly basis. Now we're seeing upwards of 10 to even 20 times that amount, depending on the month and week we're talking about. So this is an extraordinary event. It's never been tried before, and I'm not sure that we can follow past rules as much, which is why I'm really advocating for people. We have to begin to look at the signals that we've got as carefully as we can and understand that some of the things that gave us clues in the past may not be reliable this time, or they might be. We're going to have to really decide on a case-by-case basis, though.
Are you bullish on junior gold and silver stocks going forward?
Yes, I'm fairly bullish because of the metal themselves. And again, I'm a fundamental analyst at heart. Silver right now is at or below the all-in cost of production for a lot of the miners that are out there. That means that we're going to start seeing supply reductions coming forward out of the dedicated mines. That's clearly a condition that we never persists for long. You can't grow and sell corn below its cost of production for long before people stop planting corn. We understand it in the agricultural space. It's just like that in the mining space. It just has a longer lag time. And I believe we're about at the end of that cycle.
Do you think electric vehicles will continue to gain market share for the foreseeable future?
I think they're going to continue to expand in their growth, but the market share they have is tiny, and we would look for that to expand at this point in time. Clearly, we're going to need a lot more electric vehicles on the road going forward. I'm very bullish on some of the components that go into that, lithium, cobalt, as well as anybody who's involved in batteries and battery technology. These are really exciting components of this story. So yes, we're going to need more electric vehicles going forward. China's made huge announcements by really only allowing people to get license plates in many major metropolitan areas if and only if they're having an electric vehicle attached to that license plate. So there's some real key drivers going forward, and I'm looking for that trend to continue.
Are you bullish on the critical metals used in electric vehicle batteries?
Absolutely. Couldn't be more bullish on that at this particular point in time. You know, everything that you read about electric vehicles usually skips over that awkward part where you actually have to mine the metals and construct and fabricate the components. The vehicles just sort of pop out of these factories. But once you scratch through that surface, Jim, and take a look at the critical components underneath that, very exciting stories there just on a very simple supply and demand basis. We do not have the lithium, the cobalt, even in some cases the nickel, to even achieve parts of the dreams that I've seen put forward in some of the plans for how many electric vehicles the world wants.
And do we have enough plug-ins and electrical supply for them?
No, absolutely not. There's a whole infrastructure story here that needs to be told, particularly in the United States. Right here on the East Coast right now, this major storm exposed, and plus this thing called polar vortex, exposed the idea that reality, I should say, that the grid out here is just not up to the task right now of handling some cold weather. If you threw on top of that the need for another 1 million or 2 million or 10 million electric vehicles, we're in no way ready for that story here in the northeast of the United States. That's true elsewhere as well. So companies that are positioned to begin building that infrastructure out, I think, are going to be very well positioned for this story.
What are your thoughts on Canada for the new year?
Well, this is a little bit of a mixed bag for Canada. We've started to see they've had an extraordinary run in real estate prices. Many have called them bubbles, including myself, Toronto, Vancouver, Calgary, all areas where they've experienced very, very strong run-ups in house prices. We've now seen in Toronto 7 months in a row of declining house prices, so I think it's pretty safe to say that bubble is probably peaked at this point in time. There's going to be pain that results from that. On the other side of that story, Canada really is a resource story, and with oil's strong recovery here in 2017 continuing in 2018, that's going to be a big help, particularly for that Western Canada region, as well as looking at some of the eastern regions which are involved in gold mining and things like that. So Canada's a mixed bag, and really, for Canada, we have to know what's going to happen to resources going forward. Again, I'm pretty bullish on commodities going forward here.
Are real estate markets around the world in trouble?
Various places, absolutely. The rule of thumb is if the median price to median income gets up around 5, you're pretty stretched. If that ratio gets up to 6, you're very stretched. If you're up to 8, this is bubble territory. And we see places in the world where that number is 20, 25, 30, even 40 in some places in China. So it's absolutely been a stretched market in a variety of places, and we're seeing early rollovers in some of the hottest spots. So Australia started to tip over, Canada, certain locations in the United States. But, let's look at this. I'm a fundamentalist, and I think that if you have the right jobs there and you've got good incomes, you can support a strong housing market. But when you get to a condition like in San Francisco, where they now consider a family to be impoverished from a housing standpoint, if they're only bringing in $138,000 or less into a household, they will then be, considered impoverished and available for certain subsidies. Seriously, $138,000 for a household? The median income in that region is $75,000. It's clearly stretched, and either incomes have to go up a lot or housing has to come down.
Throughout history, have all real estate bubbles burst?
Well, they have. The most reliable indicator for housing and its long-term appreciation is usually inflation plus jobs. If you get those two components right, you can get a pretty good long-term read on on where house prices should be. They've clearly gone and stretched really, really far in a lot of places, and a key driver of that has been the reduction in the mortgage interest rate driven by the Federal Reserve and other central banks around the world that said, hey, we need lower rates to spur more lending. Another rough rule of thumb is that for every 1% rise in a mortgage interest rate, about 10% of the price of a house is going to come off. And that works in both directions. So we saw a lot of the appreciation in housing markets was due to the reduction in interest rates. I don't see interest rates going lower from this point. In many cases, how could they? Because they're already at zero. So unless we get into a really steeply negative interest rate environment, I think housing has gone about as far as it can in a lot of markets. And the risk is a rising interest rate environment that will actually put downward pressure on prices in many places.
When real estate bubbles burst, what percentage does the high end drop versus the low end?
Well, the high end is usually the one that gets hit a lot harder, of course, particularly if it's recession driven. And, there we're going to, we would see, it's hard to differentiate in some markets where is the low end anymore. It's Seattle, do they have a low end? And the answer is really no, they don't. So the risk here is that, when we see these housing bubbles burst, the damage can be pretty widespread. It's very painful. It really impacts a lot of things. And so we need to be careful about that. I'm a big critic of the Federal Reserve for having decided that on their own that what we needed was higher housing prices, which, hey, Jim, it helps the people who have houses, assuming they can sell them and cash that out. But of course, it hurts the first-time home buyers. It hurts the younger people, and it inhibits household formation. All things that we've seen come forward. I don't think the Federal Reserve should have the power to decide generationally who wins, who loses.
Is the Trump tax plan causing other countries to lower their taxes to remain competitive?
I haven't seen any evidence of that yet, really. It's, when you look at the overall combined tax rates in other countries, it's not just the income tax that companies pay. It also includes something called a value-added tax, or the VAT. So in other countries, combination of both corporate income tax and the VAT tax was a lot higher than the United States. In fact, on that basis, the United States already had the lowest tax rates in the world for corporations among the G20, and now we've got even slightly lower rates than that. But again, I don't know that this is going to drive a lot of decisions going forward, because other countries, particularly in Europe, they don't have latitude in their budgets right now to be able to lower tax rates. Very difficult to do politically and financially.
Has the money flowing out of China slowed down, and how could this affect China and the rest of the world?
I haven't seen any evidence of the slowdown coming out of China yet. China has anything I might say about, say, debt levels in the United States is quaint compared to what China's undergone. Just in the past year of data that I've got, credit for households increased by 30%. That means it's doubling roughly every 2.5 years. It's an extraordinary acceleration. China's been on the largest credit binge of any country in the world. When I was there last, I was in Shenzhen in one of these ghost towers, which is a huge apartment building that had been built with nobody in it yet. There's a sea of them out over there, and even with that, these apartments were trading off at 20 to 40 times income. And so China's got an extraordinary credit bubble, and they have no interest in seeing it pop, so they've been really aggressively pushing more and more credit into the system. Until that stops, we're going to continue to see these flows of money out of China, and I'm expecting that to continue.
Nationalism versus globalism, your thoughts?
Well, it turns out, some things have to be solved globally, but it seems really unfair to me to, and out of one side of the mouth, say we believe in a global environment, but we don't have a level playing field. Quick example. As a U.S. business person owning my own business, a lot of laws I have to comply with. There's tax laws, which are extraordinarily expensive, legal laws, American Disability Acts, all these things. As a culture, we can say, hey, these are important things. We believe in clean air and safe workplaces, but if I'm competing against a country that doesn't share any of those costs or ideals, then it's not really a level playing field. So in this case, I think that there are certain national industries that we shouldn't lose. There's certain capabilities that we shouldn't lose. It's a question of safety and security. I mean, for instance, the United States right now doesn't manufacture any of its own electrical substations. We've lost the capability. We've lost the know-how. It's all been outsourced. These are critical components that we shouldn't have lost the ability to manufacture, but in a global world, that's where we find ourselves right now.
President Trump said there needed to be a lot more effort to secure necessary materials that are rare and hard to find, and right now most of them are found in China.
It's a view I absolutely share, because if you can't get access to these critical resources and you're expecting to always buy them on the open market, you are exposed. And there are certain critical items out there now which are getting increasingly hard to find. We see that there's definite global competition for them, and by the way, China has been very actively going out and securing these resources with a clear understanding, well articulated by their leadership, that they understand the scarcity of these things and the importance of these things. And so they've been securing them. I think that's a rational thing for a company to do. I think it's a rational thing for a country to do.
Do millennials and boomers have different investing habits?
Well, absolutely they do. Millennials, in many cases, do not have as much investable assets out there. Millennials as well really lost faith in the financial system and the great, stock corrections and real estate corrections. So we're seeing it. A lot of millennials, of course, very excited by things like Bitcoin and other cryptocurrencies, and also looking to be investing in a much more tangible way in things that they can understand, touch, and feel. I think the idea of sending your money off to Wall Street, crossing your fingers and hoping for the best doesn't appeal to millennials as much as it did to their parents. And this is a very, very rapid, sudden, and interesting shift in investing philosophies.
Also, I was just discussing with my wife, how come we seem to have more money when we were young than young people do now, young adults? Well, we didn't have massive internet cable bills or cell phones to pay for. Those were expenses that didn't exist when we were just entering the workforce.
Well, absolutely. And if you look at the prices of certain critical things, when people say there's no inflation, it's absolutely wrong. I disagree with the way our government calculates inflation. So very quickly, things that can be imported have gone down in price, and things that can't be imported have gone up in price. So what can't you import? Healthcare, college experience here, and things like that. And so what we see, Jim, if you calculated what those things cost when you and your wife were starting out versus your children, you'll see it's just an explosion in the cost of basic things like cell phone service, television, cable service, college, healthcare. Those are all things that are vastly more expensive. And if we calculate those accurately, inflation has been very, very high. Wages have been extraordinarily stagnant. This is really a generation that has very different opportunities than when you and I started out.
Chris, how can people find out more about Peak Prosperity?
Well, our website is peakprosperity.com, and most of our content is free. We have a subscription news service as well. We run seminars. I'm out speaking all the time. So please come on by and check out the absolutely wonderful community of curious people we've got who are interested in parsing through and understanding all of these issues of today.
Chris, thank you so much for being on This Week in Money.
It's been my pleasure.
My guest has been Chris Martenson, the co-founder of PeakProsperity.com. He was speaking to us from Massachusetts, where they're busy digging out right now. Coming up, Ed Steer, next on This Week in Money.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glands Technologies owns and operates Glands Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glands Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glands Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glandspay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Ed Steer. He's the founder of EdSteerGoldandSilver.com and a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Ed, welcome back to This Week in Money.
Good morning, Jim, and thanks for having me on.
Gold had an outside month to the upside for December on the charts. Is this rare for gold, and is this bullish for gold?
Well, it's hard to say. I hate to sound like a broken record like I did last month when we did this interview, but the fact of the matter is that the chart patterns are set by trading between two groups of traders in the COMEX futures market, and that's the commercial traders on one side and the managed money traders on the other. And the commercial traders, which are mainly the U.S. bullion banks, and paint whatever chart pattern they want, but from a broader perspective, I would say it certainly appears to be bullish. We'll just have to see what the new year brings.
On Thursday, gold had an outside day to the upside on the charts. Are we possibly going to see the gold bull market we've been waiting for in the new year?
Well, everybody certainly hopes so, and that's certainly what the talk is. I'm certainly hopeful, that's for sure, and that would apply not only to gold, but also the other precious metals as well. And of course, once the precious metals start to go, then the entire commodity complex will go along with it. So, if this continues, or if the bullion banks, like I said in the previous question you asked, if they allow this to continue, then we're going to certainly see a bull market in commodities, for the ages, as the year 2018 unfolds. And of course, everybody's cheering that on, including me.
Is $1,400 an ounce for gold the long-term resistance mark?
Well, I'll tell you what, you can look at any chart pattern you want, but I don't believe in charts mainly because the price is not set by chart patterns. It's set by COMEX trading in New York. I can tell you right now that if the JP Morgan and Scotiabank and HSBC USA and a couple of other bullion banks weren't actively involved in the market right now, we'd have a gold price right now 3 or 4 times $1,400. And the only reason we don't is because they're sitting on the price. So to say that $1,400 is a technical resistance level makes no sense in the fact that the markets are being actively managed.
On Thursday, silver also had an outside day to the upside on the charts. Are we likely to see a silver bull market in 2018?
Well, I'll tell you what, JP Morgan is the kingpin, not only in the precious metals market in general, but silver in particular. Silver analyst Ted Butler, who I worked with closely for many years now, says that J.P. Morgan is sitting on 675 million troy ounces of silver they got stashed away. They're the biggest short in the COMEX futures market. And when they decide silver is going to run to the upside, it will be entirely up to them. It won't have anything to do with outside reversals to the up day or whatever the heck you want to call it. When they decide it's going to go, it's going to go. And of course, like I said, when silver goes, they're not going to go all in one by one. They're all going to go at the same time. So, yep, I'm very bullish. I'm even more bullish on silver, of course, than I am on gold.
Is silver sort of like back in the 1970s when the Hunt brothers tried to corner the market? Is J.P. Morgan doing the same thing?
Oh, exactly, and that's precisely what they're doing. And I'm certainly the Hunt brothers. What the Hunt brothers did and what Warren Buffett did was certainly one thing that prompted them to do it. And of course, since J.P. Morgan is the chief custodian of SLV and the chief stopper of all silver contracts in the COMEX futures market for the past 3 years or so. They're able to skim SLV and sock away the silver through COMEX deliveries, and besides that, they've been major buyers of silver maple leafs and silver eagles for the last 3 or 4 years, and they've just been hiding this stuff away. It's just absolutely amazing to watch, and one of these days it will be in their benefits to see a very large silver price, which I expect to be in the 3 digits.
Short-term, do the charts for gold and silver look overbought?
Yes, they do, and I was talking about that in my column the last few days, that they're looking kind of toppy right now, and we're kind of in overbought territory. But when you look at these charts, you have to remember that they are painted in this tango between the commercial traders on one side, the managed money traders on the other side, in the COMEX futures market. So this is when you look at a chart of gold, silver, or platinum, or palladium, this is a paint-by-numbers scheme that the bullion banks, particularly J.P. Morgan, can paint whatever chart pattern they want. And right now we are overbought, so if the banks wanted to, they could rip these managed money traders a new one to the downside to the tune of quite a few dollars. And if you use the past as prologue, that's precisely what they're about to do.
How are the commitment of traders numbers looking for gold and silver?
Well, last week's commitment of traders report was not pretty. It was a big surprise to the negative surprise. The fact that the big 8 bullion banks stepped in on the short side almost immediately when this rally started during the first week last week before Christmas, and the one that comes out in about 2.5 hours from now, I expect to be even more wildly bearish, wildly bearish, and Ted Butler has gone on record saying it's going to be ugly as sin. And of course, since the Tuesday cutoff for this report we're going to see today, things have deteriorated markedly more. So the COT report is, I hate to say it, but is right now, if we could see the one as of the close of business today, would be just as bearish as it was a month or so ago.
Do the junior gold and silver stocks look like they're ready to run?
Well, they certainly should be running. There isn't a gold mining company out there or a silver mining company out there that's producing the ore or producing metal right now that isn't hugely undervalued compared to what it should be. Its cash flow and the amount of money they got in the bank. And they should all be trading for several multiples of what they are right now based on how well they're doing just today, but the interest isn't there because the price activity isn't there. That will change someday, but right now everybody's on Bitcoin and in the general stock market, and it's unfortunate, but the precious metals equities just aren't responding like they used to. They will again, but it's going to take a while before people swing back into that sector, but the day will come, although it can't come too soon for most of us, including me.
Will it take a crash in cryptocurrencies to do that?
I'll tell you what, I sort of keep one eye on the cryptocurrencies. I don't own them. I'll never own them. It looks like a huge Ponzi scheme to me. Since when did ones and zeros become money? I guess to some people they are, and they may go even higher than they are now, but if you want to talk about cryptocurrencies intelligently, you're talking to the wrong guy.
How are platinum and palladium doing?
Well, they're doing very well for themselves, especially palladium. Palladium has sort of been trading in a world all its own for the last 6 months or so, and it really hasn't been affected much by what's been going on, particularly in gold and silver. I don't think the powers that be, the banks, really care what palladium does, and they're letting it run to the upside, and it's had a big, big run. It's now up to, $1,100 an ounce, and I see they stopped it there yesterday. But, platinum and palladium are basically industrial metals, and the boys can let them run to the upside without too much damage. Nobody's going to start going out and buying shares of platinum companies because there are only 3 or 4 or a handful of them on planet Earth anyway. The biggest worries, of course, are gold and silver because those are the most noticeable of the precious metals. But as far as platinum and palladium, I think they'll continue to run to the upside.
At some point, are the manipulators of gold and silver likely to run the prices higher and higher?
Well, they don't have to run the prices anywhere. All they have to do is stop selling short in the market. When the managed money traders and everybody else is going long, all they have to do is put up a closed, gone fishing for 2 weeks sign. And if there's nobody to sell, prepared to go short against everybody who wants to go long, I guarantee that we'll see a 3-digit silver price before the trading day is over, and a very, very large 4-digit gold price or 5-digit gold price before the day is over as well. That's all the banks have to do is stop selling short into the market when everybody wants to go along. So we could see any price we wanted to if they decided to put an end to it.
Is the U.S. dollar continuing its bear market?
No, there's no question about it, and I think the dollar's got a lot further to fall. You know, I follow the dollar very closely in my writings every day, and it's obvious to me that what I call gentle hands are in the market whenever it looks like it's going to head lower too far, go down too far too fast. As I've said many times over the last 6 months, this is a controlled devaluation of the U.S. dollar, which started on January 1st, the first day of the trading year in 2017, and is continuing unabated, and the dollar's got a lot further to fall. And how fast it falls, I don't know, but I would suggest that if those hands were there, it would be a lot lower than it is today.
Are higher gold and silver prices good for the Canadian dollar?
Well, they're good for any commodity-producing country. You take any commodity-producing country out there, whether it be in South or Central America or Africa or even the United States, for heaven's sakes, or Russia, or any of the countries that are hewers and wood or drawers of water, it would certainly help the Canadian dollar. It would help the African rand. It would help the Mexican peso, whatever Chile uses, and Argentina, Australia would help all these countries' currencies. But as long as what I call the Anglo-American Empire is sitting on commodity prices, the currencies of the commodity-producing countries are going to stagnate.
Ed, what's new with the Gold Antitrust Action Committee?
Well, we're still out there, passing out the word that the prices of gold and silver are being managed. But we've been doing this now, for 17 or 18 years, almost a generation. And there isn't anybody in the gold business or silver business that doesn't know now that the prices of the precious metals are being actively managed by half a dozen bullion banks. So the message is getting along in the tooth, but we're still out there. I know Chris Powell goes to conferences all over the world, and Bill Murphy and I are going to be speaking at the Vancouver Investment Conference coming up in 2 or 3 weeks. And we're just going to keep pounding on the way until this thing comes to end. And Jim, you've been doing these interviews for a long time with lots of people, and everybody wants this thing to end like right now.
Ed, how can people find out more about your newsletter?
Well, all they have to do is Google my name. My name is Ed Steer, S-T-E-E-R, and my website will come up, edsteergoldsilver.com, and the freight is $100 a year for 200-plus columns, because I write one every day the U.S. markets are open. They can read a sample column on my homepage, and they can take a look at that, and if they're interested, they're more than free to sign up.
Ed, thank you so much for being on This Week in Money.
My pleasure.
My guest has been Ed Steer, founder of edsteergoldandsilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Chris Martenson, and Ed Steer. And thank you for listening. Any questions for the show can be sent to info@howstreet.com. Plus, a reminder at the end of the show, we'll have a company showcase update with American Manganese CEO Larry Ray. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Ray, President and CEO of American Manganese. Happy New Year, Larry.
Well, Happy New Year, Jim, and I'm always pleased to be on the show.
The stock market's been pretty good to American Manganese. How has it been in the past week?
Well, the last week hasn't been very good for American Manganese. All the other stocks, not all of them, but a lot of them were moving up, heading north, and all the indicators were there that it was going to be a great market for the year, and yet we were going down on unprecedented volumes. And I just have to say again, you have to go back to my previous articles that are posted on the website when it comes to predator trading, and it was pretty obvious that predator trading has been going on for some time in the company. For example, we had great volumes all through December, and we, pretty much hung in the average 30-cent range. So that told me, as well as a report that said we were 2 million short, that we had shorters in the market, and so now they were going to capitalize on those shorts by bringing the stock down in this last week, and which they did. They took it down almost 20%. And interestingly, Jim, if you look at the trading in the stock, you'll see there's a big offer there by National Securities at 25. And the whole object of that is to put a lid on the upside while creating panic selling on the downside so that the shorts could cover. And I don't think that was completely successful. And the last of that order was yarded out today, and we closed up, got back half of our losses. So, again, this is predator trading. It's going to happen. All the news for the solid year was good. We're getting international recognition. Off that recognition, we're getting all kinds of solicitations for potential synergies. And so that's all good. And all I can say is that let's hope that next week starts out good and we get away from this short trading, and maybe we can make up some losses and start making some gains. And I'm looking forward to a real busy year. It's we got quite a few things in the works right now that will be coming about in next, shortly in releases. And so again, I think the shareholders should rest comfortably that there's no bad news out there. And from what I'm reading from recycling companies that are contacting me, that we do have the leading edge technology for getting back the cathode materials. So, that's nice to have that confirmation from companies that have been doing business in recycling for 20, 30 years. And speaking of that, one of the recycling magazines put out an article today that basically covered the critical metal aspect that we reported on a week ago. And that was the Waste Management World. And Waste Management World put that article out. We sent it out to our readership, or not, shareholders. And again, it's coverage from a big circulation, and we've already got a couple of queries off of that. And I'm sure that some of the buying that comes into the market is a result of this recognition. Again, that just reinforces that the company is recognized as a player out there, and potentially a major player. So that's always good to have. Certainly, we've had a lot of press, and all of it's been quite favorable. So I think that we can look forward to another active year, and maybe we can start to see the prices going north, which I know a lot of shareholders would like to see. And that's not much more that I can say about that, except that, it's tough to live through a route like we went through the first 3 days of this week. It affects everybody. It even affects the management. It affects me. It affects everybody. I mean, you get frustrated. And, but, you just got to keep your shoulder to the wheel, and you'll eventually overcome all that.
Larry, for new listeners, can you maybe explain the primary mission of American Manganese?
Our primary mission, Jim, is to bring a recycling process to fruition. Now, we've already proven that we can get 100% of the lithium-ion battery material back, cathode material. And that's a big plus. That's disruptive, and nobody else is making that claim. Now, so our focus is on the recycling, and that recycling came out of our focus on manganese a few years ago, in which we developed a process that allowed us to produce manganese from very low-grade deposits in the U.S. at comparative costs to China. And, it didn't succeed because the price of the actual metals and the dioxides went down. And they were going down all the time. We were doing a pre-feasibility study on it. But now we're capitalizing on that. This work that we'd previously done opened the door for the recycling. So we're basically working off of 80 years of history, because the U.S. worked on that process since the First World War, and they were never successful in accomplishing what we finally did in 2011. Now, focus being on the manganese, I'd just like to point out one thing. We have talked about what the value of the batteries were for 85 kilowatt batteries. Now, I just want to caution that all batteries are not 85 kilowatt. They could be 65 kilowatt, which would make a smaller battery in size and weight, and the chemistries may or may not change. But, our template is at 85 kilowatt, and we think that, there's a huge future. I think I mentioned that on 85 kilowatt battery in a previous podcast, 100,000 batteries for a nickel manganese cobalt battery under the existing chemistries of that battery was $170 million worth of cathode material. That's in 100,000 batteries. So you just take that and you say, well, what does that mean? Well, what it means is, when we're talking about 3 million vehicles out there, and let's say that a quarter of them are nickel manganese cobalt, that there's already in existence a $500 million worth of material that could be processed in the next few years. It's not going to all be done at once, and the batteries won't be available all at once. I don't believe there's going to be any second use a year from now, because you don't want to tie up cobalt-bearing batteries on a wall unit. And it just doesn't make sense when you can use lesser materials. The most demanding battery that you have is the electric vehicle battery. And so you want to have the best materials you can get and a guaranteed supply of that. And we can alleviate the cobalt problem and the lithium problem through the recycling of these batteries. So that's a thought that I'd like to leave with everybody. And I guess I'm finished with that portion of it, Jim. I can move on to where we're traded. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded on the U.S. Exchange under the symbol AMYZF, and we're traded in the Frankfurt Exchange under the symbol 2AM. We have a website, AmericanManganeseInc.com. We can be contacted at 778-574-4444, or you can send me an email direct at REAUGH at AMYMN.com.
Larry, thanks a lot for the update.
You're welcome, Jim.
We've been speaking with Larry Ray, President and CEO of American Manganese. I'm Jim Goddard. We were talking on January 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.